Okay, very good morning. Monday the 12th of March. Hope everyone had a good weekend. Just going to do a wrap up then of the major headlines from really the last 2 days, Saturday and Sunday, what we've seen from overnight, and then how the charts are set up for this morning. A couple of things then to look ahead for the week ahead predominantly, because quite a key week for US economic data, of course, as we get closer to that end of March, and the important interest rate hike that's expected by the market, by the Fed, and the subsequent projections as well, and what shape they could take is really dependent about the incoming data largely this week. In addition to, of course, the wage situation and non-farm payrolls. So having a quick look at that first, just to recap briefly, we obviously had in short, a very mixed initial reaction, but then the overwhelming focus, of course, was on that wage data, which disappointed. So irrespective of the fact that we had a very high number, 313,000 on the headline change in non-farm payrolls, it was the wage data, which, if you remember back on the what would have been the 2nd of February, that really sparked then that big sell-off on the 5th of February in the US equity market, when the wage component, the year-on-year average hourly earnings, exceeded expectations. We almost had the reverse of that, and in fact that 2.9% previous even got revised down by 0.1 as well. So once the market quickly got over the initial knee-jerk reaction of the headline figure, we saw then, as you well know, quite a big move in the market. Equities here, you can see center right, the S&P, and it was just one-way traffic really all the way. I mean, that's an impressive move for the S&P for any stretch of the imagination, really, in a one-session move. So from 2740 all the way up to breach the 2800 handle this morning. I was just looking at the S&P on a bit of a longer dated chart to get a bit of an idea and a sense of where we are at the moment. And obviously that data helping us breach quite a key level in the evening of that session. If I go a bit closer, it was around that kind of evening time here. We initially tested that level up around that 2790 before the break came, and then here we are at the moment. So the reason I'm looking at that back at that end of February kind of resistance point, which would take us all the way back to, well, really this is the sell-off that I was just talking about. So this was exactly here. If I just put a rectangle here, that was the non-farm print that caused the subsequent sell-off on the following Monday, when people all of a sudden panicked about the emergence of this inflationary conditions and so on and so forth, the net effect that would have for more rate hikes in a faster fashion from the Fed. And if you look where we are this morning, we're exactly then, of course, back to that price point. So we've pretty much taken it all the way back to the exact tick, almost. On the upside then, well, as I guess a near-term support and resistance I'd be keeping an eye on would be a similar type price level, so around this 2790, 91 area as support, now that we've got through that. And on the upside, I'd be probably looking in terms of the week ahead, 2814 and a quarter, that being really then the kind of areas here that we were at the beginning of Feb, end of Jan, before that initial dip that we took, because they were previous points of resistance as well. If we go back to, well, we're looking back to January period here, before the initial move up to, of course, which was record territory after that phenomenal run that we had. I think it was, what, 7.5% or so alone in the month of January. So some upside levels here to be aware of, and then also on the downside around that 90, 91.5 type level. A lot of people obviously talking about throwing those words around of a Goldilocks scenario again, because you've got low levels of unemployment, so strong jobs data in the form of people getting jobs, but the fact that inflation continues to remain low, meaning that, well, the Fed can't really afford to hike rates if inflation really isn't picking up pace, and so the accommodative period to remain in place from a monetary policy point of view. So this kind of drives then this equity sentiment that rates are going to go up in a very slow and cautious manner going forward. And if the market was getting itself into this 4 rate hike, 5 rate hike mentality, well then that's been severely pared back, and hence the reason you had such an aggressive move. One thing to consider though this morning is that overnight Asia obviously had the first time to react to this information, so a very positive session overall ex-Japan, which we'll have a look at. A bit of political uncertainty emanating from some stories at the weekend. So just to make a bit of sense of this, the DAX obviously gapped up given the solid gains that we're seeing on Wall Street, and then overnight in Asia. It would be absolutely no surprise to close the gap here and probably come back to pivot, I'd say, in terms of the DAX. Because as much as I think that the equity price can remain supported, I think this is probably a little bit overdone, this initial move higher to R2 in the futures. You can see when the cash is open, just some, I think quite understandably so, some profit taking. You know, Europe's really had a reaction to this already. You can see this first point of resistance where the DAX has come to 12,400. That being the initial highs that we're seeing on the immediate reaction to payrolls. Any break of that, I've got no doubt in my mind, would come back down to, well, that double top kind of really from the futures close last Thursday night, and then probably pivot would come into play pretty quickly beyond there. Just having a look here on the DAX, slightly more short term, some areas here that could be interesting just for the week as a whole. So just looking further down, that level there looks quite interesting. The 12,275.5. You can see that's roughly a support point here, resistance back here, and also here as well. So that's a pretty big level. I'd definitely be looking out for. And looking a slightly longer time frame, well, really that's that level I've just identified here, that 275 level, kind of 275, 274. You can see does have relevance, and that was the one that Sam was looking at quite closely before we had the initial break, which you can see there was some pent up almost momentum on that initial break and how it's acted as support as well. So I'd be expecting that to be a pretty significant level again in the context of the week if we were to get back down to those low points. And then on the flip side, on the upside, probably just looking at the initial range, probably the first port of call will be around that close to 12,500 level, and then beyond there, up more circa to the 12,600 for the range, going back to the 26th, to the end of February. But yeah, a little bit of a move lower after the initial gap up in the DAX. And I think this is just purely a bit of profit taking in that respect, because Europe's already in large part had a chance to react to that payroll data. Currency pairs, it is pretty quiet. The dollar index only marginally lower, so given the Dixie's down about 0.1%, both major pairs seen just slightly higher. Euro dollar up about 10 pips. Cable also up, irrespective of a kind of avalanche of Brexit headlines over the weekend. I think, you know, I have the app on my iPhone where it kind of selects the news that it thinks you're interested in. I think there's about 50 different articles about Brexit, and you can certainly expect that to pick up even further as we go through the next 2 weeks, because of course by calendar you've only got another 2 weeks until we'll get that absolutely critical EU summit, of which the baseline scenario is the UK are going to be able to secure this transitional deal. Failure to do so is obviously going to be highly detrimental to likelihood, the confidence in the existing government, and this would bring into question then the leadership of Theresa May, and this could then become politically very destabilising, which would more often than not equate to local currency weakness. On that point, actually, I did see just a neat summary of key events in the Brexit negotiations, so I'll pop this in the chat after I've delivered this briefing, just so you have it to hand. But we've kind of covered this already a few times. So this is the meeting that's coming up, and securing this transitional deal, which is really key. But in the aftermath of this, you do have the UK May local elections, and this really is, as it states here, a key test of public opinion that could lead to the softening of government policy, which would be key. The summer and thereafter, depending on the shape or the sentiment that comes of those local elections, could then lead to the government softening of its stance on policy if Theresa May hasn't really come out of this whole negotiation particularly well, with the key point being at the end of this month. It could lead to those other options. A leadership election, May's resignation, as bulletproof as she's kind of seemed so far, and then the kind of lower probability, but certainly a possibility, a new general election, which could then lead to all kinds of different things, because going by pollings, if Labour were to edge out Conservatives and then look to form a coalition of themselves, then all of a sudden Brexit becomes a lot more of a softer option in terms of the staying in the customs union, and so on and so forth. So yeah, I'll pop that in the chat room when I'm done. So all of that, though, I'd say is broader perspective at the moment, and it's not really having too much of a near-term impact on the pound for this week. As we get towards looking at the calendar for the week ahead, I'd certainly be looking more to the US economic data and movement subsequently in the dollar on any movement of thinking around the Fed hike outlook for the future, in addition to this ongoing trade talk that I think will probably be more influential, at least for now. But just wrapping up the UK, we do have, of course, the Philip Hammond, the Chancellor, delivering the spring statement. Now, one thing you'll remember, that when he outlined the budget, he did make the decision to move to just one budget a year. So instead of usually you would have had the two different periods kind of semi-annually, now we're just moved to one. This in attempt to kind of stop the fiddling with the tax system has been met quite well overall by the investment community. So having outlined his budget in November, Tuesday, which so tomorrow, is billed as a pretty boring affair, really. We're going to get some updated economic and public finance forecasts, a few new public consultations on possible tax reforms, and estimations, according to the FT, that the House of Commons speech might last no more than 20 minutes. I mean, if you think about the usual bets that go in for the length of the budget, when he does the speech after the usual PMQs, it can last up to an hour. So we're looking at a much more brief affair this time round. In summary, a few things that we're looking at this week with that speech from the Chancellor. Headline figures in the spring statement will be slightly stronger than at the budget, reflecting better than expected official data published in the last 4 months. So this is in regards to the economy and GDP figures. Public finances, the Office of Budget Responsibility, so this is the OBR, they indicated last month that it will make a significant downward revision to its estimate of public borrowing for 2017-2018. So tax receipts have performed better than expected, culminating in robust revenues for January, when most self-assessment bills fell due, and this suggests economic activity was stronger than previously thought. So this is kind of I'd say pretty much a recurring theme from the likes of the OBR and a lot of economists generally, I'd say, in reference to the UK economy, which generally have been more pessimistic, and the economy, all not great, has outperformed those most pessimistic forecasts. But overall, I would say I don't think this is particularly going to be a tradable affair, and I guess in the broader context, very difficult really to take too much or read too much into what the Chancellor is going to say, given the fact that this obviously comes just a week and a half or so ahead of that key EU summit, and so the securing of a transitional deal, or the complete opposite of that, a complete breakdown in talks, is definitely going to shape then either positive or negatively people's outlook for the UK economy going forward. So I would say any forecasting about the UK economy at this precise point in time should be taken with a huge pinch of salt, because it's going to be subject to very large and substantial revisions, I would think, given the Brexit negotiations ongoing. Okay, the Japanese story that I said that I'd just highlight to bring you to your attention. There's been a little bit of movement in the local assets overnight, in the yen and the Nikkei. So to cut a long story short here, Japan's opposition has demanded the resignation of Finance Minister Taro Aso in regards to a scandal over cut price sale of public land to a nationalist school operator. So the scandal has escalated to become the most serious threat to Shinzo Abe, the Prime Minister's government, in more than 5 years. Mr. Abe himself could be at risk when he seeks another 3 years as the Liberal Democratic Party leader this autumn. I was listening to Squawk this morning, and they were talking about the fact that Abe had said if there were any more scandals, then he would look to step aside. So hence the reason markets are a little bit nervous then that this might disrupt the kind of political harmony, if you like, that might have been in place in Japan because of commitments that were made before that Abe was going to kind of clean up his party, and now this kind of crony mentality of helping out using these kind of positions of power that has caused some political instability. So maybe worth just monitoring it, but again, hasn't really caused a huge reaction in the market at this point. Just getting down then to the week as a whole, and there's a couple of peaks of interest for sure that you're going to need to be aware of. Today you have the EU Finance Minister meeting taking place, and probably the main thing I'll be listening out for here is possibly not so much Brexit, but more the European response to the ongoing tariffs that are being proposed by the US administration. We heard from this time last week Juncker pretty forthright saying to America that if you do that to us, then we'll retaliate. And then that prompted Trump to talk about then not just talking about aluminium and steel, but throwing in the tariffs on UK car makers from Europe looking to export into US. So that's going to be what will be interesting. How are the EU, what are they thinking at the moment on that specific point, which is obviously critical for an area that exports a large volume of goods to one of the biggest buyers in town, which of course is the United States of America. Other than that, today is relatively quiet, and so going to Tuesday, that's probably going to be one of the main data releases that we're going to look out for, and that's because we've had the wage data. So irrespective of really a further tightening of the labour force, let me just go back and show you. Now, this is the US unemployment rate here at the bottom. So let me just quickly change my chart, make that window a little bit smaller so you can see it. So there you go. US unemployment rate, that's at the bottom. This is 2012 going all the way through from left to right to where we are at the moment. And that 4.1%, this is the 5th straight month at 4.1%. Jobs, as we've said, for the consecutive 3 months have gone up and up and up to this 313,000, which really we've got to go back all the way to summer of 2016 when we were last printing at these levels. And you can see as a kind of range high, 300 plus tends to be around the best levels that we've seen over the last several years. So irrespective of this though, this of course is what matters. And the tightening of the labour force, the Fed have been telling us for a long period of time, is what is going to equate to higher wages, and then as a knock-on effect, this is going to start meaning that people can spend more disposable income, and that will force demand to pick up and prices to move higher, i.e. creating inflation. But as you can see here, if we were mapping payroll job creation, that's gone up, 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 and the wage number's gone down, down, down. So it's not looking overly confident for policymakers to make a decision purely on just this one metric. So then what's going to be key, and the reason why I say Tuesday economic data is going to be so important, this is when we get US inflation, and core inflation will be key. This is what core inflation in the US looks like at the moment, and if you remember, that did come out 0.1 higher than expected last month at 1.8%. But 1.8% we have seen before, and in fact we've seen 3 of the last 4 readings have been at that level. What's going to be key is Do we get up to 1.9%? That's definitely going to make the market feel a little bit more comfortable that they've made the right assumption in regards to this kind of overarching focus that inflation is indeed picking up. And if the Fed are in fact going to go to 4 rate hikes this year, I think that really this number really needs to come up to 1.92%. Otherwise, I think that the Fed are going to really struggle to fit in off-cycle interest rate hikes. You know, the Fed like to move when they have the summary of economic projections and the press conference with Powell, and so that would be March, i.e. this meeting, but then telegraphing to hike in June, SEP and DEC. I'd see it a little bit more of a struggle for them to do an off-cycle one. If that were to materialize, it'd probably be later in the year. But this data is really key to determine this, and so the market likely will be quite responsive in market movement to that reading. UK spring statement, as we just talked about, that's on Tuesday. Going through to Wednesday, you're looking out for the PPI numbers as well from the US, but importantly, you also get retail sales, so obviously another key component as to ascertain the health of the economy and the consumer. A couple of speakers from the ECB as well, including Mario Draghi. And then on Thursday, you start looking out for more US data, New York Empire State Manufacturing, your weekly jobless and export-import prices. And then on Friday, you do have quadruple witching taking place. So do note, we can talk about that more at the time, but it does tend to lead to a little bit of volatility, added volatility in this particular situation. And then you've got US, Michigan, and the inflation rates, but these are final coming out of the Eurozone. So I'd say from a scheduled point of view, probably where you need to be focused if you're looking at the beginning of the week, looking forward to how to kind of allocate your attention or the kind of where the trade opportunities might come, sparked by fundamental and macro developments. I'd say Tuesday and really Wednesday is probably going to be the peak of interest in that regard. All right, that's it. Going to leave it at that. Let you guys get on with it. Coming up to 9 o'clock, so I'll wish you a good morning and a good week ahead. I'll do the weekly strategy report this morning, and I'll have that out to you hopefully by midday. All right, take care.